Hey everyone, welcome back to Corporate Decoder. Today we're diving into Generation Income Properties or GIPR's latest quarterly report. This report is a bit like a roller coaster, some ups, some downs, and a few loop-de-loops that might make your head spin. Get ready because the ride might get a little bumpy. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. So what exactly is this report about? Well, GIPR is a company that invests in properties like stores, offices, and warehouses and then leases them out. This report is basically a checkup on how the company is doing, covering everything from its assets and debts to its profits and losses. It is called Form 10Q. We need to look at it so we know what the state of the company is. We're checking under the hood to see if everything's running smoothly. Let's start with the company's balance sheet. This is a snapshot of what the company owns, its assets, and what it owes, its liabilities. At the end of March 2025, GIPR reports total assets of about $116.7 million. A big chunk of that, about $98.5 million, is tied up in their real estate investments. This is their main game, owning properties. Now let's peek at the liability side. GIPR reports total liabilities of approximately $81.8 million. That means they owe quite a bit to various lenders and creditors. A significant portion of that is from mortgage loans, clocking in at $64.6 million. So a lot of their assets are paid for through debt. Moving on to the income statement. This is where we see how much money the company is bringing in and how much it's spending. For the first 3 months of 2025, GIPR reports rental income, their main revenue source, of roughly $237 million. But when we look at expenses, things get a bit dicey. General and administrative costs were about $505,000. Building expenses were $630, and depreciation and amortization, the using up of assets, was about $1.3 million. And here's a big one, interest expense, that is, cost for borrowing money, was a hefty $1.18 million. After all the income and expenses are factored in, the company reports a net loss of approximately $1.8 million for the quarter. Not great. That translates to a loss of 0 per share for common stockholders. The statement of changes in equity shows how the company's ownership structure is changing over time. It shows a decrease in stockholders' equity from about $5.8 million to $3.1 million. A big part of this is due to that net loss we just talked about. They are losing more than they are keeping. It mentions the conversion of preferred stock, a type of stock, into common stock, but also distribution on non-controlling interests. So there isn't much cash flow happening, but the balance of assets, liability, and equity is definitely changing. Now let's move to the statement of cash flows. This statement tracks the actual movement of cash both in and out of the company. This is the health beat of the company. The company starts with that $1.8 million net loss we saw earlier. It adds back non-cash expenses such as depreciation, the using up of things of around $833,000, and amortization, the gradual writing off of an amount for assets of approximately $364,000. These are expenses that don't involve actual cash going out the door. Then it considers changes in things like accounts receivable, which decreased by approximately $157,000. The money they are owed, the balance for account payable, increased by approximately $470,000. Ultimately, this results in net cash from operating activities being around $718,000. Not bad, but this means that despite the net loss, the company is generating some cash from its core business. However, cash flows from financing activities were significantly negative, around $700,000 due to repayments on mortgage and distributions. Not good. Overall, their cash and cash equivalents, easily accessible funds, increased by just $17,000, which is basically flat. Finally, it's critical to note that over $1 million was paid in interest. Wow. The nature of operations section gives us some background about GIPR. It states the financial statements are following the standard accounting rules. Management's assessment of their ability to continue operating. This is where things get interesting. It admits that there is substantial doubt about the company's ability to continue without more money coming in. Their plan involves actions like refinancing debt and selling off assets. Not great. It gets worse when you factor in the competition is very tight. Significant accounting policies are the specific accounting procedures the company used to prepare the report. The details are pretty standard stuff. What's important is that you as a viewer know that the calendar is their basis for reporting that. I'm going to skip some accounting details but scroll to other items such as real estate amortization, and all to continue looking under the hood. Redeemable non-controlling interests are basically the amount of stocks owned by others that are not fully in control by the company, and net loss income for the period affects these. This note breaks down the company's debt obligations. These loans encumber many of their properties with high interest rates, a major issue that the company must consider. It also says that the company was in compliance with all covenants except some project level debts. If the ratio is not high enough, the company will be forced to pay out cash, and that would hurt even more. Other is all of the details. In particular, the executives say they did their jobs correctly. What is not disclosed elsewhere is that 3 tenants, with GSA being the primary, make up 10% of the revenue. This is bad because if GSA would go, the company would have to replace 14% of their revenue. So what's my take? On the positive side, DAPR does have a decent portfolio of properties, but honestly, this report raises some red flags. High debt levels, continued losses, and that going concern warning are all concerning. And the fact that the company is paying its CEO a considerable fee while simultaneously bleeding cash. There are some concerning trends. The interest obligations from loans and the preferred units payments are all in red, meaning the company owes it. I see some short-term profitability as the key to getting over their substantial doubt, but they really need to sell some of the assets to deleverage and get on track with their operating cash flow. Alright, that's our breakdown of Generation Income Property's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.